Meet Alex and Rayan. They're both 28 years old. Both have stable full-time jobs and both earn $70,000 a year. For years, they've lived below their means, skipping expensive vacations, driving used sedans, and saving every extra dollar they could. Over time, they've each managed to save $60,000. For both of them, it's the biggest financial milestone of their lives. Alex has always believed real estate is the absolute best way to build lasting wealth. He likes the idea of owning something tangible. Ryan sees things differently. He believes the best investment is the one that quietly grows in the background without demanding his time or energy. So today, we're not comparing every dollar Alex and Ryan invest. We're comparing two very different strategies for building wealth. Let's follow their journey over the next 20 years. Let's begin. Alex decides to use his $60,000 as a 20% down payment on a $300,000 rental home. It's nothing luxurious, just a well-maintained single-family house in a solid suburban neighborhood. To finance the purchase, he takes out a 30-year mortgage at a 6.5% interest rate. His monthly principal and interest payment comes to roughly $1,517. Fortunately for Alex, just a few weeks after closing, he finds a tenant willing to pay $2,100 a month. The numbers look fantastic. Each month, Alex collects $2,100 in rent. After making his mortgage payment, it looks like he has nearly $583 in pure profit left over. It almost feels too easy. Ryan takes a completely different route. Instead of buying property, he invests his $60,000 directly into a total stock market index fund. No leverage, no tenants, no repairs. After covering his living expenses, Ryan still has about $250 left over each month. So he sets up an automatic recurring investment of $250 every single month. Once everything is configured, he closes the app and gets on with his life. Ryan's investment doesn't feel exciting. There's nothing to visit, no rent check to collect, and nothing to proudly show his friends. Just a number quietly growing inside an app on his phone. On day one, Alex looks like the obvious winner. He owns a physical house. He has a tenant. He feels like an active investor building real wealth. Ryan has nothing more than a brokerage account and a confirmation email. One investment feels real. The other feels invisible. But investing isn't about what feels impressive. It's about what actually builds net worth. During the first couple of years, everything seems to go Alex's way. The rent check arrives on the first of every month. Every mortgage payment chips away at the loan. He drives past the property after work and quietly smiles, thinking, "I own that." Ryan has a very different experience. Every few months, he logs into his account. Sometimes the balance is higher, sometimes it's lower. The gain seems small, and the excitement is non-existent. There's no physical building he can point to, just numbers quietly changing on a screen. From the outside, Alex looks like the ambitious investor. Ryan just looks patient. 3 years pass. Now, let's compare where they actually stand. Pause the video right now and comment below. Who do you think is ahead at year 3, Alex or Ryan? Over those 3 years, Alex collects roughly $75,600 in rent. His mortgage payments total approximately $54,612. On paper, that's nearly $21,000 in positive cash flow. But there's one small problem. That number only exists on paper. The moment you own a rental property, the real bills begin to arrive. Property taxes, insurance, routine maintenance, and empty months between tenants. Then there's Alex's time. To save money, he manages the property himself, handling late-night calls about leaking sinks, scheduling contractors, and vetting applicants during lunch breaks. By the end of those 3 years, after accounting for true property expenses, Alex has realistically kept only a few $1,000s in net cash. That $21,000 paper profit, it got eaten up by a new hot water heater, property taxes, and turnover costs. Ryan, meanwhile, has experienced something far less dramatic. His original $60,000 investment has continued growing, and he's added $250 every month without interruption. Assuming the historical stock market average return of 10% annually, his portfolio has grown to roughly $89,800. He hasn't answered a single phone call from a tenant. His money has simply worked quietly in the background. But Alex still holds one enormous advantage: leverage. His rental property was purchased for $300,000. After 3 years, assuming a modest 4% annual appreciation, the home's value has climbed to roughly $337,000. Meanwhile, mortgage payments reduced his loan balance to around $232,500. That means his total equity has climbed to approximately $104,500. That's genuine wealth, and a large part of it came from controlling a $300,000 asset with only $60,000 of his own money. That's the unique power of real estate. But here's the part the gurus online don't tell you. Rent is not profit. Before that money reaches your pocket, you have to account for the core real estate expenses. Vacancy. Budgeting for 1 month empty per year means 1 month of paying the mortgage completely out of your own pocket. CapEx and maintenance. Homes wear out. A standard rule is budgeting 1% to 2% of the home's value yearly for repairs. On a $300,000 home, that's $3,000 to $6,000 every single year. Property management. If you don't manage it yourself, expect to pay 8% to 10% of gross rent to a manager. 5 years later, Alex is no longer the wide-eyed first-time landlord. He's an experienced one. He's gone through 3 different tenants, replaced an entire HVAC system, and dealt with a severe plumbing emergency. Rent has increased to $2,300 per month, but property taxes and insurance have climbed right alongside it. His actual cash-on-cash return settles around 4% to 5%. Ryan's journey looks almost boring by comparison. By year 7, his portfolio reaches roughly $142,000. Something powerful is beginning to happen. His portfolio is now generating more in annual compound growth than his entire annual contribution. By year 10, the comparison becomes fascinating. Alex, real estate. Property value hits $444,000. Mortgage balance is down to $200,000. Total home equity equals $244,000. Rayan, index funds. $60,000 principal plus $250 per month contributions equals $208,000 total portfolio value. Alex is ahead by $36,000. But look at the sweat equity metric. Over that decade, Alex spent over 400 hours fixing issues, handling leases, and coordinating repairs. That extra $36,000 in equity required hundreds of hours of manual labor and carrying $200,000 plus in debt. Rayan achieved his $208,000 completely passive, liquid, and stress-free. Another 10 years pass, bringing us to the full 20-year outcome. Alex's property has continued appreciating. After 2 decades, the house is worth roughly $657,000, and his remaining mortgage balance has plummeted down to about $118,000. Alex's home equity, $539,000. Alex's lifetime net cash flow, $145,000. Alex's total wealth built, $684,000. Now let's look at Rayan. His initial $60,000, combined with $250 monthly contributions, compounded at 10% annually over 20 years. Rayan's total out-of-pocket contribution, $120,000. Rayan's compound growth, $508,000. Rayan's total wealth built, $628,000. Alex, real estate, $684,000. Rayan, stocks, $628,000. 2 completely different strategies, ending at nearly the exact same financial destination. Alex built his wealth through leverage, active labor, and local appreciation. Rayan built his wealth through passive compounding, patience, and global diversification. Neither path is universally better. They are simply tailored to different personalities. Stocks come with brutal market crashes where your account balance drops 30% on screen. Real estate comes with middle-of-the-night repair emergencies, bad tenants, and illiquid capital. So, which strategy actually wins? That's the wrong question. The real winner isn't determined by the asset class. It's determined by finding the strategy that aligns with your stress tolerance, your willingness to work, and the lifestyle you want to live. The next time someone tells you real estate always beats the stock market or stocks always beat real estate, ask them one simple question. Did you calculate the hidden costs and the value of your time? Because the answer that accounts for everything is the only one that truly matters. If you found this comparison helpful, hit the like button and subscribe for more deep dive wealth breakdowns. Which strategy would you choose? Let me know in the comments below.